Years, corporate debt was seen as a normal, even smart, part of doing business. Companies borrowed money to expand, invest, and grow. Low interest rates made borrowing cheap, and as long as profits were rising, debt didn't seem like a major concern. In fact, in many cases, it was encouraged. But today, that perception is changing. Corporate debt is no longer just a tool for growth. It's becoming one of the biggest risks facing businesses. And the reason isn't just that companies have more debt than before, it's that the entire environment around that debt has shifted. To understand why this matters, you have to look at how companies used debt over the past decade. During periods of low interest rates, borrowing was extremely attractive. Companies could take on large amounts of debt at very low cost. This money was used for a wide range of purposes: expanding operations, acquiring competitors, investing in new projects, and increasingly returning capital to shareholders through buybacks. As long as borrowing costs stayed low, this strategy worked. Debt was cheap, manageable, and often boosted returns. But that model depended on one key assumption: that borrowing would remain easy and inexpensive. That assumption is now being challenged. Interest rates are higher. And more importantly, they are less predictable. This changes everything. When rates rise, the cost of servicing debt increases. Companies that borrowed heavily in the past now face higher interest expenses, especially when they need to refinance existing debt. And refinancing is where the real risk begins to show. A large portion of corporate debt doesn't last forever. It has to be rolled over, bonds mature, loans come due, and companies must either repay the debt or refinance it at current market rates. If those rates are significantly higher than when the debt was originally issued, the cost can increase dramatically. This creates pressure on profits. Money that could have been used for growth, hiring, or investment is instead used to service debt. And for some companies, this pressure becomes difficult to manage. Another key issue is how much debt has accumulated. Over time, many companies increased their leverage, meaning they took on more debt relative to their earnings. This made sense in a low-rate environment, but it also reduced their margin for error. When conditions were stable, high debt levels were manageable, but in a more volatile environment, they become a vulnerability. If revenue slows down, costs increase, or markets shift unexpectedly, highly leveraged companies have less flexibility to respond. They are more exposed to financial stress. There's also a change happening in how investors view risk. In the past, investors were more willing to tolerate higher levels of corporate debt because returns were strong and alternatives were limited. But today, investors are more cautious. They are paying closer attention to balance sheets, debt levels, and financial stability. Companies with excessive debt may face higher borrowing costs, lower valuations, or reduced access to capital. This creates a feedback loop. As debt becomes riskier, it becomes more expensive, and as it becomes more expensive, it becomes even harder to manage. Another important factor is the shift in corporate strategy. As we've seen across industries, companies are focusing more on resilience and stability, but high levels of debt can work against that goal. Debt reduces flexibility. It limits a company's ability to invest, adapt, or respond to unexpected changes. In a stable environment, this might not matter, but in an uncertain one, flexibility becomes a key advantage. And companies with heavy debt burdens often have less of it. There's also the issue of where the debt is concentrated. Not all companies are equally exposed. Some industries, particularly those that require large capital investments, tend to carry more debt. Others, especially those that grew rapidly during low-rate periods, may have taken on debt to fuel expansion. This creates pockets of risk within the broader economy. If conditions worsen, these areas could face more significant challenges. Another emerging concern is private credit. In recent years, a growing amount of corporate lending has shifted away from traditional banks and toward private lenders. These loans can be less transparent and often come with different risk structures. While this has made capital more accessible, it also introduces new uncertainties. In times of stress, these markets may behave differently than traditional banking systems, and that adds another layer of complexity to the overall risk environment. There's also a timing issue. Many companies locked in low-rate debt in the past, which has delayed the impact of rising rates. But as that debt matures, the effects become more visible. This means the risk is not always immediate. It can build gradually over time, and when it does surface, it can do so quickly. What makes this situation particularly important is that it affects more than just individual companies. Corporate debt is deeply connected to the broader financial system. It influences investment, hiring, economic growth, and market stability. If large numbers of companies face difficulties managing their debt, it can have ripple effects across the economy. This is why analysts and investors are paying closer attention to it. But it's also important to keep perspective. Not all debt is bad. Used wisely, it can still be a powerful tool for growth and investment. The issue is not the existence of debt, but how it is managed. Companies with strong cash flows, disciplined capital allocation, and manageable debt levels are in a much better position. They can handle higher costs, adapt to changing conditions, and maintain stability. But companies that rely too heavily on cheap borrowing may find themselves in a more difficult position, and this is where the real shift is happening. Corporate debt is no longer just a background factor. It's becoming a central part of business strategy. Companies are thinking more carefully about how much they borrow, how they structure their debt, and how it affects their long-term resilience. In many ways, this marks the end of an era, the era of easy money, and the beginning of a new one, where discipline matters more, risk is taken more seriously, and financial stability becomes a competitive advantage. Because in today's environment, the companies that succeed are not just the ones that grow the fastest, they are the ones that can handle pressure. And for many businesses, that pressure is now coming from their own balance sheet.